welcome to Options for Beginners. I'm Sean Howell.
And I'm Rick Swope. We want to thank you for joining us. We're going to introduce you to the language of options.
In the early 1970s, options were developed as a way to mitigate risk. Traders were experiencing high volatility, and they were using options to help hedge their positions.
Now, you may have heard that options are inherently dangerous, but that's not necessarily the case. Of course, options, like any other trade or investment, are going to have associated risks, but they don't have to be excessively dangerous. Let's look at something you might be familiar with, and that's a credit card. Are credit cards dangerous? Of course not. But if you don't know what you're doing with them, or if you're not disciplined, you can get yourself into a lot of trouble. And the same is true with options. Options are not inherently dangerous, but if you don't take the time to study and learn the risks and rewards associated with options, you can get yourself into trouble.
Now, let's take a scenario where you want to buy a stock. First of all, we want to put our money in the direction of the money flow. So we have to look for a stock that is in an upward trend.
Let's assume we're going to buy 1,000 shares and we're going to pay $50 a share for that stock. It will cost us $50,000 to make the purchase, and we can hold on to it for as long as we want. There's no expiration on this. You decide when you want to sell that position. Now, if your stock pays dividends, that would be one way to profit from this trade.
And if the stock stays right at the purchase price, you'll get that dividend as a return on investment. If you buy that stock at $50 and it goes higher than $50, you're going to make a profit. On the other hand, if it goes lower than $50, it's going to be a loss to your account. Now, let's look at how options may be used in this trade.
Okay, so we take the first example. We bought the stock. What can we do a little bit differently using options? Well, let's introduce the first option, the call option. The call option is going to give you as the buyer the right to purchase the stock for a certain price, and you get to specify that price. The price at which you get to buy the stock, which you choose, is called the strike price.
Let's use an example you might be more familiar with. Let's say you're buying real estate. The buyer and the seller agree on a couple things. They agree on closing date. They also agree on the price. Now, for call options, the price that's agreed upon beforehand is called the strike price. The closing date is going to be the expiration date for that option.
Now, of course, you're going to have to pay a fee for the right to buy the stock for the strike price. That fee is called the premium. It's very much like the down payment in a real estate transaction. It's not the full amount, but it's a smaller amount that locks you into that contract. So with a call option, you'll pay a premium in order to receive the right to buy that stock at a specified price.
Let's take a look at what might affect the value of that premium in the call option.
There are several things that will influence the call premium. Let's start with the first one. That is going to be your selection of the strike price. As the strike price is lower, there's more built-in value in that call option. We call that value intrinsic value. As intrinsic value gets higher, you're going to pay more premium for the call option.
There are a couple of other things that will have an effect on the call premium. The first is time value. The longer the time left before the expiration, the more premium you're going to have to pay for that call. Second, the volatility of the stock will influence the cost of the option. Increases or decreases in the stock price volatility tend to be reflected in premium increases or decreases.
Now understand, there's not a one-to-one relationship between the option and the stock. In fact, one option contract represents 100 shares of the underlying stock. So if you wanted to control 1,000 shares of stock, you would need to buy 10 option contracts, because 10 times 100 would be your 1,000 shares.
Now let's take a look at our next example. We're going to buy 10 option contracts, which represent 1,000 shares of the stock, and we're picking a strike price of $50. Another factor to consider is the time frame. We're buying an option that has 2 months left until expiration, while the stock is trading at $50 a share.
Okay, now follow us, because we're going to look at a couple of aspects of this particular trade. As was mentioned, we have 2 months until expiration, so we can only use this option contract for 2 months. After that, 3 months, 6 months from now, it's completely worthless to us. A couple things could happen from this point. Typically, when the stock price increases, the call premium increases. When the call premium increases, we could sell the call for a profit. But there's also a risk here, and that is if the call premium decreases, which typically happens when the stock price drops. Well, in that instance, we would sell the calls for a loss.
Let's consider how we would manage risk. If we buy the stock, how can we protect that position against falling prices? In our next example, we're going to buy 1,000 shares at $50 and then use options to protect our trade.
You might be saying to yourself, I didn't even know I could protect my trade. And you can with our second type of option, and that is the put option. As opposed to the call option, which gives you the right to buy, The put option is going to give you, as the owner, the right to sell your stock. So you own the stock now, and by buying a put option, you have the right to sell that stock. Now guess what? You also get to choose the price at which you'd like to sell the stock. That specified price, very similar to the call option, is also called the strike price.
Let's look at a put option using an example you're more familiar with. If you purchase auto insurance, you pay a premium for the term of coverage. In return, the insurance company will provide protection against loss. Well, the same thing applies for a put. You're paying a premium, and in return, you're receiving value, the ability to sell that stock at a predetermined price. The put option will be valid for a specified term and then expires at the end of the term. That date is the option expiration.
What affects the premium of a put option? Well, just like with a call, there's going to be a built-in or intrinsic value to this. With the call option, remember, the lower the strike price, the more intrinsic value there is. With the put option, we turn that around. The higher the strike price, the more expensive it's going to be because we have more intrinsic value.
And just like the call option, there are going to be a couple of other variables that are going to affect the premium, one of which is time. The time remaining until expiration will affect the price of the premium. More time equals higher premium. Finally, as the underlying stock price has higher volatility, that volatility will be reflected in a higher premium for the put option.
And we want to remind you once again that each option contract represents 100 shares of the underlying stock.
So if we have 1,000 shares of the stock, we would buy 10 put contracts to protect our trade. Here's an example. We buy 10 put contracts with a life expectancy until expiration of 2 months with a strike price of $50. Now this is all happening while the stock is trading at $50 a share.
All right, let's take a look at this and see how this one plays out. As Sean just mentioned, we have 2 months left until expiration. So these contracts are only going to be good for 2 months. After that point, they're worthless. Now here's what it looks like. If the stock price falls, we have a couple of choices. The first is this. We can take that put contract that we own and we can go to the market and we can say, I want to sell my stock for the strike price. When we do that, that's called exercising our option. But another thing we can do if the stock price falls is we can sell our puts because they're going to be worth more and simultaneously sell the stock. Now understand, this might be a little bit confusing, but the key point here is this. Whichever choice you make, you'll have more protection by owning the put contract than you'd have without it.
Now, if the stock rises in value, the put option is going to expire worthless. But that's okay, because you're going to be profiting from the long stock position.
You know, we've introduced a lot of terms now, and we want to bring this all together by actually walking through some option trade scenarios. So we'll start with the buyer.
The option buyer pays a premium for the right to make a trade.
On the other side of that, with every right, there comes an obligation. So the seller will actually collect that premium, and in exchange, they place themselves in an obligation.
Let's take a look at a call buyer. A call buyer is paying a premium to the seller of that option, and the call buyer has the right to purchase the stock at the strike price.
Remember that with every right comes an obligation. So the seller of the call option places himself in an obligation. Their obligation now is not to buy the stock, it's to sell the stock. The seller of a call option is obligated to sell the stock.
Let's turn things around here for you and look at a put buyer. A put buyer is also paying a premium to make a trade. The put buyer has the right to sell his stock.
On the other side of that is the person who sells that put option. He collects the premium, and in exchange, he places himself in an obligation to buy the stock. Just remember, the right goes with the obligation, the buy goes with the sell. Now understand there are a lot of new terms and concepts. Speaking the language of options is really like learning to speak a language. It's not reasonable to walk right in and expect to speak it fluently.
Like a language, learn one word at a time, one sentence at a time, one phrase at a time, and with a little practice, you'll become more fluent. Make sure you visit the E-Trade website for more educational videos. I'm Sean Howell.
And I'm Rick Swope. Thank you for joining us in Option